In Asia Pacific, we see actually two different trends. On one side, we saw already for a couple of quarters the trend of clients being lower on transactions, holding back on transactions. But on the other side, we've seen specifically this quarter a real big net new fee generating assets coming through, 3.3 billion in Asia Pacific, which basically shows you that clients are moving away from transactions into mandate business. And that's been always part of our strategy. And after 3 quarters of lower transaction revenues, you actually see that they're now looking for other solutions to invest their money and basically doing it through mandates.
But do you see any reason to believe that that marketplace and the United States and Europe are going to get any better, given the concerns we have about recession, the ongoing war in Ukraine, and the fears that China constantly keeps locking down because of COVID?
Well, Jeff, I think you named them all. So at this moment, we're really looking at some tough circumstances in terms of where is this all going, whether it is in the US or whether it is in Asia. Honestly, I'm a little bit more positive towards the end of the 3rd quarter and the 4th quarter. I do believe that in Asia, towards the end of the 3rd quarter, we'll have more clarity around the political situation in China, with that affirming up of economic policies, with that probably further lifting of COVID restrictions as well. That actually should be a bit of a fuel to more optimism, and with that markets rallying further. That's on that side. On the other side, for the US, we don't expect a significant slowdown. So from that perspective, we are still positive about the US, although, depending on where things are going, it could tip into a slowdown there as well.
It's a Federal Reserve week. I think the market is worried about how quickly interest rates are rising. Not necessarily a totally negative story for you. Can you just explain for us how these interest rate rises are affecting your business?
So if you look at our business in the US, but in general globally, specifically in the wealth business, I think that's where you see the big difference here. So you see on our recurring revenues, you see a decrease because of the level of the markets having gone down. You see on the transaction revenues a decrease as well because of clients being sidelining their investments. However, you see a 24% uptick in net interest income on the back of raising rates. And as a consequence of that, the overall revenues in the wealth management business for the quarter was only -2% in very difficult circumstances.
Cost-income ratio, you've held it very well, I would say, given the inflationary environment we have and the expectations that employees seems to have now that they're going to get pay rises that match inflation rates. Could you just talk a bit about the challenges of keeping costs down in this environment where we have such high headline inflation?
Yeah, clearly inflation pressures also work through our cost base. Not only the inflation pressures themselves, also still a strain on some of the labor markets in which we're active. The US is still tense, Asia Pacific, still some pressure there on the labor markets as well. Having said that, as you know, when we announced the strategy, we also announced a cost savings program of 1 billion. Also this quarter, we're completely on track to save the 400 million for this year. So on one side, we see headline inflation coming through also in our numbers. On the other side, we have that savings program, and then combined with lower revenues, also a lower variable pay coming through. That's how we keep our cost under control.